So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to The Daily Call. Today we are going to be answering the question, should we trade options after a merger or a buyout is announced? So this is, again, a question that came from our community, so thank you so much for submitting your questions to me because it definitely helps out. So the reality is that when a merger or potential buyout of a company is announced, what people typically often think, and what typically happens, is that the stock now trades dramatically higher based on the agreed upon share price. So if company A says that they're going to buy company B for $10 a share, then the stock immediately starts trading to that. And it's usually a premium that the company is going to buy them for a premium so that all the shareholders and, board members will accept the deal and approve it, right? So then the stock starts trading immediately higher. But the reality is that even though that it had a lot of volatility heading into that event, or that one-day event is so volatile, the vast majority of them that are approved and that are going to go all the way through to the closing of the transaction would actually see that the stock price changes very little from that offer price of, say, $10 a share. So can you trade options around this? Sure, you could, but volatility is going to be almost nothing. And so you're probably not going to get as much premium out of it as you think you would. Now, the only other times you would want to maybe set up a strategy around this is if you think that there's some sort of uncertainty in either the deal being accepted or there is the potential that other bidders might come into place. So if company A says they're going to buy company B and they're going to buy for $10 a share, sometimes we actually might see the stock trading higher than $10 a share. And people will ask, well, why is it trading higher than $10? And that's because maybe company A was just the first. Maybe because they offer $10, we might see somebody else now come in and offer $12 or offer $15 a share, and we might get a bidding war. We also could see the stock actually trading lower than the share price offer. So if the company is offering $10 a share, we might actually see the stock trading at $8. And again, the question is, well, why is it trading lower? They're offering $10. Well, because we don't know if it has to pass some sort of regulatory hurdle or some sort of approval process that has to go through, or the board has to approve it before anything happens, or if it's a hostile takeover. There's a lot of uncertainty in that as well. So I think the reality is that in the case of options trading, yes, you could probably make some plays in that. Yes, you could probably trade some things around it if you think, one direction is going to be more impactful versus the other. I would say anything that you do in that case has to be pretty much risk defined. I wouldn't do anything undefined risk as far as trades go. So I wouldn't do any straddles or strangles. If I was going to do anything, I would do credit spreads or directional spreads and just make a small bet. It'd be a good, play or just have fun with it really. But I would not bet the house on doing these types of trades. They don't come up that often. And because they're so infrequent, there's not too much data, and every position is kind of independent of one another, that I don't think there's a consistent framework around how you can trade them. So again, if you want to trade them for one-off type positions, knock yourself out. It's not something that I do typically at all, but it's something that you can do if you want to. You just have to understand the context of how the deal is being set up and presented. As always, hopefully this helps out. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.